Good afternoon, or it's probably good morning, ladies, actually, by the time that you are going to be viewing this particular narrated PowerPoint. This is the first of the narrated PowerPoints to go with course companion 12, which is financial markets and monetary policy. So I'm going to go through it step by step. I think there's probably going to be about 4 PowerPoints in total to cover the whole booklet, but this obviously is the first one, and hopefully it will help you. And I'll give you some guidance on how to follow both the booklet and also the PowerPoint itself. Okay, so the first thing we're going to take a look at is the financial sector in general, and obviously you can use your course companion 12 booklet and sort of follow this through. So it's essentially the PowerPoint is helping you to understand what's included in the booklet, and hopefully in most instances it will help you to understand the content a wee bit more. So without further ado, let's go then. So we're going to take a look at the financial sector in the first instance. So one of the first areas you're going to need to be aware of is the structure of financial markets and also financial assets. So some of the key things that you're going to need to know, and this again is within your booklet on page 3, but also just talks to you a little bit about the content that is required to be covered as far as the specifications concerned. So you're going to need to understand a little bit about the characteristics and functions of money. Also look at the differences between the money market, the capital markets and the foreign exchange markets. And you're not really going to need to go into this in huge amounts of detail. You just need to be aware of the differences between the different parts of the market. Okay. So the role of financial markets within the wider economy is something you will need to consider. Differences between debt and equity, and then also when it comes to looking at bond prices and market interest rates, the fact that there is an inverse relationship between the way in which bonds work, and there's quite a nice worked example in your booklet which hopefully explains that in a reasonable level of detail. Some of the other things you'll need to be aware of is how firms raise finance, including shares, issuing corporate bonds, and obviously borrowing from a bank, and also a little bit about the way in which banks actually create deposits and lend money, etc., etc. So those are the key sort of areas that we're going to be looking at in this first presentation. Okay, so functions of money then. 4 things really. 1, it's obviously a medium of exchange. Number 2, it's a measure of value. Number 3, it's a store of value. And number 4, it's a method of deferred payment. And if you go back into the history of money, before we had money and before we valued money in the way that we do, then obviously it was very much a bartering process that was very much involved. But the key areas are, as mentioned there, there are 4 key areas that are covered on page 3 in your booklet. In terms of the characteristics of money, 3 main forms, and as I mentioned before, prior to us having money and using money as we do these days, the process was very much a case of bartering, so swapping one set of goods for somebody else's set of goods and making a reasonable swap. Now clearly there were some issues around that, but fundamentally there are 3 essentially main forms of money. So the first one is commodity money that's mentioned, and that's very much where the thing that was being used as the item of money had some sort of intrinsic value. Okay, and then that eventually moved from a commodity towards more of a representative money, which essentially was gold and silver, and the fact that effectively the gold and silver deposits within the Bank of England were the things that underpinned the value of money, if you like, in the first instance when we first went to sort of the use of token money, and in essence that token money has no intrinsic value at all other than the fact that it is a promise to pay the bearer a certain amount of money. And as long as we accept and understand that that is the process that we're going to go through, then obviously the system of the money supply, and obviously in this instance being able to exchange goods and services is what's used as far as what the money supply is used for effectively. Okay. When we look at this specifically, then what the money supply is, it's essentially, as mentioned on the slide there, it's a stock of financial assets which function as money. Okay. So a little bit then, if we move on from page 3 and take a look at page 4, there are some definitions about narrow money and broad money that you can take a look at, but also the difference between equity and debt, which is quite an important distinction. Okay, so equity is any assets that you might have, or that people that are either physical or financial assets that people own, whereas debt is essentially what people owe or their liabilities. Okay, now clearly one of the biggest liabilities that anybody might have in the future is probably going to be a mortgage on your home. So essentially, you're buying a house, but you haven't got the sufficient amount of money to be able to pay for that house outright, and so you take out a loan in order to do that. And that's clearly a debt that has to be repaid at some stage, and obviously attracts interest too. Some key definitions on the bottom of page 4. Financial markets, capital markets and money markets, and also the distinction between different types of retail bank, both commercial and investment banks, and then a little bit more about different types of saving and equities, and also a brief mention of derivatives, which again is something that you don't really need to get too concerned about. It's something that if you want to find out some more about, there's loads of information out there. Very complicated and quite a risky sort of process, but basically it's using financial instruments to try to sort of predict how well a particular set of stocks or shares might work. So again, page 4 covers some definitions for you, but then we go on to look more specifically at some of the roles that the financial sector has. Okay, now one obviously is to facilitate savings, and clearly in some instances savings are considered to be a good thing, and obviously in certain situations, you might argue that households might choose to save for good reason, firms might choose to save for good reason, and governments might choose to save for good reason. And we'll look at that in a little bit more detail when we look at monetary policy and the way in which the Bank of England and the government might try to influence that. But one of the key things to bear in mind is that in developing economies and developed economies as well, a high level of savings ratio tends to mean that the market, the economy, is likely to also be very investable. And what I mean by that is that if a higher proportion of people save money, then you could argue that if they save money for whatever reason, because their interest rates are high at the time, or they're choosing to sort of hold on to their money, if you've got a high overall savings ratio, you're also then likely to have a relatively high level of investment in the future. So that's something to bear in mind. Okay, and you can obviously go and find out some more detail about the reasons why households, firms and governments might choose to save. So that's the first thing, facilitating saving. Second thing is obviously to lend to businesses and individuals, and again there are a whole range of reasons why households, firms and governments might choose to lend money, and obviously the financial sector has a fairly fundamental role in allowing that to happen, or to encourage that to happen, in order that people can choose to borrow money in order to invest it, or to maybe expand their business if we're talking about firms. But again, each different in this case, audience, the households, firms, and governments. Each different economic agent will have different reasons why they might choose to borrow money and then use that maybe to expand their business or as far as firms are concerned. But governments obviously have other reasons for doing it too. Okay, so some lending takes place both in money markets but also in capital markets. Okay, so money markets tend to provide short-term financing for up to 1 year, whereas capital markets tend to provide long-term financing, which tends to be greater than 1 year. But again, we'll look at that in a little bit more detail, and it's also covered in a little bit more detail on page 5 in your CC12 booklet. Okay. If we look at the next point, then another role of the financial sector is to facilitate the exchange of goods and services. Okay. Now, clearly, that's one of the main fundamental principles of the way in which we use money, isn't it, to exchange goods and services for in this case, money, and the financial sector is responsible for helping to facilitate that whole process. So financial institutions create payment systems for goods and services. So the central bank mints coins and prints banknotes. But retail banks might offer check services and debit and credit cards. And obviously, one of the other things to bear in mind is that as time goes by, things like checks, for instance, and the use of cash seems to be becoming less and less important because we have so many sort of debit and credit card transactions taking place constantly, and again, it's very much a case of a lot of the transmission of money is electronic transmission from one account to another, rather than literally a transmission or a transfer of a certain number of £1 or £5 notes or £20 notes or whatever from one account into another. So that's worth bearing in mind too. Okay. We've also got a number of institutions like Visa, Amex and MasterCard that offer credit card services to banks, retailers and individuals. And we've also got banks and bureau de change that will buy also and sell foreign currency. So again, each one of those things is designed to help to try to encourage the exchange of goods and services, to make it easy for us to be able to trade within a country, within an economy, but also with other parts of the world too. Okay, further info on the role of the financial sector then. The fourth point, to provide forward markets in both currencies and commodities. Now, this is where it starts getting slightly more financially complicated and a little bit more tricky to understand. But effectively, in some cases, forward markets are known as an example of a derivative market. So effectively, what some people will do is they will actually try and future gaze, for want of a better term, and try to actually say, well, we think that this particular currency market or commodity market is going to change, and we will actually try to predict that. And in some cases, that can be quite a risky thing to do, but it also can be a very lucrative thing to do if you get that right. And it's one of the things that some investment banks will get quite heavily involved in. There's quite a nice link to this whole principle about future contracts and the price, in this case, of coffee or cocoa rather. And that's quite a nice tutor to you link that you can go and take a look at and answer some questions on both how farmers and chocolate manufacturers might actually be able to exploit those positions and the reasons why they might choose to do that. Okay, so I'll give you some time to have a look at that and obviously take some notes and add that to page 6 in your booklets. Okay. There are a couple of other things to consider as well if we're talking about these different types of marketplace that the financial sector is providing us, and one is capital markets. Okay, we mentioned earlier that capital markets are about long-term financing, normally over 12 months. Now, one of the main ways in which firms and governments will raise finance, particularly capital within capital markets, is to issue bonds. Both firms and governments will issue bonds that are considered to be very secure. They are long-term loans, essentially. So a typical government bond might be redeemable for £100 in 25 years' time, and obviously, when the person or the organisation that's decided to take out that bond, the original price of them buying that bond is £100, but they're guaranteed a rate of interest, it looks like a relatively low rate of interest, but they are guaranteed that interest rate for each year of the bond's duration. Now, bonds can actually be sold in the second-hand bond markets as well. So you might choose to actually buy a bond and then sell it to somebody else because you just want to try and get some of your money back. And obviously the way in which that works and this inverse relationship between bonds and prices is actually shown quite neatly on page 7 in your booklets. But in addition to that, there's actually quite a nice relatively short YouTube video which actually talks a little bit about how or who buys Britain's government debt and how much needs to be sold. And that link is both in your booklet on page 6, but also on this PowerPoint. And provided you're viewing this PowerPoint in full in its full finery and in the full presentation mode, those links should work for you to go and take a look at the that work. In addition to me doing this narrated PowerPoint, you've also got, in addition to that, on Teams, you've got the actual PowerPoint, the first PowerPoint, and also a digital version of the booklet too. So you should have all that you need to be able to access the info that you need to. Okay, so that video clip is definitely worth a watch. I think it's about 4 or 5 minutes long, but it gives you quite a nice summary of the way in which bonds are issued and why and how people choose to buy them. Okay. Okay. If we then take a look at page 7, I mentioned to you that there's quite a nice example of the way in which bonds, number one, look, and number two, explained how they are valued, and essentially gilts or corporate bonds are basically fixed term securities sold by the government, and when they borrow in the long term. Now, again, I'm not going to go through exactly what's included on page 7, but it explains it hopefully quite neatly. But in addition to that, there is also a further explanation of bonds and how bonds and yield calculations are included by Econ plus Style, which is obviously in this instance in your PowerPoint, and there's a link there to YouTube where Econ plus Style, in his own inimitable style, explains the principles of bonds and also yield calculations. So that might be useful just to sort of take a look at and just make sure that you understand the principles of bond prices and interest rates and how they vary. Okay, so let's move on and take a look at the capital markets in a little bit more detail. Okay, and we talked briefly about capital markets, but one of the key things that they exist to do is to provide a market for equities, so company shares, effectively. Now, capital markets are basically made up of two different parts. You've got new issues market and you've got the second-hand market. So if you're talking about a new issue, that would be a company that's maybe coming to the market for the first time and is choosing to become a public limited company of some description, and basically is issuing shares for the first time. Well, the second-hand market for shares is basically the London Stock Exchange, and the reason why the FTSE 100 is often quoted is because the FTSE 100 is the top 100 companies in the UK in terms of their market capitalisation, which is basically the number of shares times by the share price at any particular time. So that's clearly one area that that capital markets is used and obviously a lot of the things that we have to talk about and the things that influence the value of shares is to do with business performance, and obviously that's very closely linked to interest rates and to government policy and the whole range of other things, which is what we're going to be looking at as we move on to look at the next couple of presentations and cover some of the monetary policy information that's included in later in the CC12 booklet. Okay. You've also got foreign exchange markets where different currencies are traded, and you've also got commodity markets where commodities are traded. So effectively, capital markets essentially are shares. Foreign exchange markets are currency trading, and commodity markets are literally commodities like, for instance, metals or cocoa or orange juice or whatever it might be, where commodities are also traded, bought and sold essentially. Hopefully in most cases for a profit for those people who are actually going through that process. So we mentioned briefly about this principle of financial markets and UK household savings, and also talked briefly about the principle of having a high savings ratio. Now, clearly, in any situation, if you've got a high and an increase in the savings ratio, that can actually do a number of things. One, it can obviously cause a fall in aggregate demand, and it could potentially cause a recession, certainly in the short term, because if people are choosing to save, they're choosing not to spend. So that obviously is going to have an effect on aggregate demand. And if that then means that people start to stop demanding more as many goods as they previously did, that might then mean that producers don't need to produce quite so much, and that might then mean that that they will reduce their output and productive capacity to reflect the amount of demand that's in the market. Okay, but if we take a look at the longer term, if you have a high savings ratio, it's often considered to help to promote more sustainable economic growth, because if you think about it, like we said before, if you've got higher savings rates, then that's going to enable more private sector investment in the longer term. Okay, there's a couple of questions at the bottom of the slide here which actually relate specifically to page 9 in your booklet, where you've also got an example of an extract which shows UK household savings ratios from 1960 through to 2017, and I want you just to take a quick look at that and see what sort of information that is telling you. Is there any specific trends, but also maybe use that information to help you have a go at answering those two questions. So, a key role of financial services to provide an easy way for people to save their surplus income. Assess why saving is important to the health of the economy. So, given what we've talked about and given the amount of info that you're aware of as far as this is concerned, that's something that I think you'd be more than happy to have a go at answering. Okay, and then the second question there, a key role of financial markets is said to be to facilitate saving. Discuss whether the data provided should be data provided, not date provided. I do apologise. In extract A, which is again at the top of page 9, and whether in this case financial markets are either succeeding in that task or failing. So that data you should be able to use that to support an argument either for or against whether financial markets are helping to actually achieve that overall process. Okay. And then there's a little question for you to do a little bit of research on, which basically looks at London as a financial centre. Clearly, still quite an important, still a very important area for us as a country, but also we on a world stage are still considered to be quite an important player in that particular market. There's 10 statements there that I want you to go and have a little think about. And also see whether you think those are true or false. You might need to do a little bit of research on that, but basically that gives you an idea of the first section of the booklet, the first sort of 10 pages, which covers information like we talked about, so the structure and of the financial sector, and also some definitions on money, and also the way in which financial assets are bought and sold, if we're talking about gilts, etc. So hopefully that's given you a good platform for the first part of CC12, and we'll move on and take a look in the next presentation at commercial banks and investment banks and what the differences are between those. Okay, thanks for listening, and hopefully you find this useful, and we'll catch up soon.